All right, so while you look at this cartoon, it's kind of an interesting little just cartoon. We have a bunch of people taking a test, and it's how important are ethics in today's society. And as you can see, they're all cheating off of the one person sitting in the middle there. So it's kind of an interesting take on this topic from a cartoonist's perspective. The one other important thing that's with this slide is there's another code, that letter to be given out, and that code letter is T as in Thomas. So code letter T, and that will be continuing on with our other codes as part of this presentation. We will need that as well. So that's an important piece of this training as well. Okay, next. So we're going to look at some ethical cases here over the next few minutes, and we're also going to talk about some various scenarios, and we'll kind of take you through the just some potential options that you may have if you were to come across these various topics, and we'll give you a moment to reflect on them, and we'll kind of break up the presentation a little bit. So let's just start with a couple quotes here. The first quote is, "A man without ethics is a wild beast loosened upon this world." And this was a quote from Albert Camus, who was a French philosopher and Nobel Prize winner back in the 50s. So you can do some research on him if you're interested in what his philosophies and takes were. And so let's just jump right into the ethical dilemmas. So how this is going to work is I'll go through and read through the various ethical dilemmas, and then I will pause for probably about a minute or so and just let you kind of think through the specific thought process as to what various options you may have, and also just give you a chance to reflect on the scenario and kind of think through what would you do if faced with this specific situation. And then we'll come back and we'll talk about the kind of options that I kind of came to that you may or may not think through. And the interesting part this is when this course is taught live, there's a lot of commentary that goes on relating to the various transactions and dilemmas, and sometimes the feedback is always interesting because some people have different takes on it, and a lot of people bring a lot of their own experiences to the table as to how to best handle these, and sometimes there really is no good answer as part of the case, right? I mean, there's always somebody that may be harmed, but ultimately, you kind of know it, as we've talked about all along. You kind of know what is the right and wrong answer just based on your social upbringings, as well as what is right and what is wrong. So the first ethical dilemma is your supervisor enters your office and asks you for a check for $150 for expenses that he tells you that he incurred entertaining a client last night. Seems pretty innocuous, right? Nothing crazy there, okay? He submits receipts from a restaurant and lounge. But at lunch, your supervisor's girlfriend stops by to pick him up for lunch, and you overhear her tell the receptionist what a great time she had at dinner and dancing with your supervisor the night before. So in this dilemma, there's a couple things. So based on that, I will give you a minute to think about it, and then I will come back and we can talk about it a little bit. All right, so as we start to think through this, a couple questions you may have surrounding this is, well, maybe there was a client involved in this and it was like a dinner function or something along those lines. So you may be thinking, well, I need some more facts and some more information on that. And that totally makes sense, right? This is a very, very simplistic example, but with a lot of facts that may be missing as a result. So what kind of options do you have? I mean, your first option is to just go ahead and process the check and pay the $150 for expenses. Another option that you have is to talk to your supervisor about it and get a get their take on it. Third option would be to inquire about the about the expenses as to if there was other parties involved. And obviously you wouldn't be able to talk to your supervisor about it if they're the ones authorizing the check, but maybe the supervisor's supervisor. Or lastly, if the company has a ethics hotline, you could always reach out to there if it really was something to where you felt that your supervisor was not dealing with it appropriately, nor was your supervisor's supervisor bringing it to the appropriate resolution in your mind. There is always another outlet in addition to that generally available to you as an individual. So, okay, so that's the first one. So let's go to the second case. You work in a company's IT department. One of your key responsibilities is to track usage of the company's internet access and to validate that employees are using the internet solely for business purposes in compliance with the company policy. So your firm or your company has a policy as to what can and can't do it. They may or may not block it. Generally, most companies will block the internet usage for various sites and limit those sites. And so during one of your routine analysis, so you go through and you look and see what everybody's activity is, you notice that one of your coworkers, Nancy, has been accessing a career finder website. You have been instructed to report any and all violations to your immediate supervisor. Historically, these similar violations have led to disciplinary actions, and in most cases that individual is terminated. And while you don't know Nancy very well, you do know that she's a single mother of 3 young children whose husband died over a year ago. So what would you do in this situation? And again, I'll give you about a minute to think about that, and then we can regroup and kind of walk through some scenarios on that one as well. So in this situation, you've got an example of where you oversee all of the various violations that may or may not occur in accessing a career finder website. And I think this one seems pretty straightforward. Or two alternatives that I can think of is either report it or you don't report it. Right now, depending on which path you choose, I always feel like if you don't do something, it's going to get found out eventually. So let's say you go down the road of not reporting it. Well, there's always the case that maybe somebody will oversee your work and may find out that you're not doing what you're supposed to be doing. So it would be reflective negatively on you, and you may have repercussions in addition to what Nancy's doing. Obviously, if you report it, this would potentially result in Nancy losing her job. But again, I think ultimately it's a very, depending on how you feel about this, if you do report it, she is aware of the policy and the procedures out there. So it's almost something where we're all responsible for our own actions, to where ultimately she should know better and shouldn't be doing this on a work computer if she is truly looking for a new job. So just a couple alternatives out there for you to think about. Those are the ones that I was able to come up with. So if we go to the next specific slide, Roberta is actively involved in her daughter's Girl Scout troop. For the past three years, she sent an email to everyone in her department during cookie sale week to let them know that she takes orders at her desk. There have been no complaints in the past, but she has never asked management permission to do this. Recently, a new employee who is a direct report of Roberta complained to HR that she felt pressured into buying cookies from Roberta. The employee is a single mother of limited means, but feels that if she doesn't buy cookies, it will reflect poorly on her and could reflect her annual appraisal by Roberta. The employee has asked to remain anonymous. So you are included, you're a member of HR and this individual has called you about this. How would you handle that matter? So one important piece of information on this that's been left out is, does the company have a specific policy as it relates to these type of items? Or is it kind of just general practice that if somebody's selling something that they send these emails out and there is no pressure to purchase anything? Interestingly, in this one, it sounds like there was direct pressure being applied to this employee by Roberta to purchase the cookies. So as a member of HR, you would probably have to look at your individual policies and procedures to determine if there is something to speak to Roberta about. That's obviously one way of doing it. Another way to do it is basically as HR could go to Roberta and tell her to cease and desist on the sale of cookies. So that is another option. Or thirdly, they could just ignore the complaint and bury it in a file or something along those lines and just pretend it never happened, right? Those are three plausible items that could happen. Anecdotally, as everybody, I'm sure a lot of you are aware, I'm definitely a big proponent of Girl Scout cookies, so I will not be offended if you ask me to purchase any. I may have hit my quota on purchases for the year, so I might have to turn you away, but I am definitely not shy about eating Girl Scout cookies, so do not feel that you will ever offend me by asking to buy Girl Scout cookies for what that's worth. On to the next one. A coworker, Jessica, asks to add you as a friend on Facebook. You accept her Facebook request. Since you now have access to Jessica's Facebook page, you see things such as her political views, affiliation, her list of likes, the groups she is a fan of, and after-hour photos of her that some may think are inappropriate. Is it acceptable to talk to other coworkers or even Jessica's supervisor about the things you learned from Jessica about her via her Facebook page? So on this one, it's the Facebook question, and I think a lot of us probably do have a social media presence. So what we do with that social media presence is really a personal decision, a personal preference. Obviously, it's becoming more and more bleeding into the public arena. Obviously, LinkedIn does play into that to a certain extent, as well as Facebook. The interesting thing here is that you now see some information that maybe is not flattering of her, and so the question becomes, is it acceptable to talk or not to talk? So I mean, ultimately, there's really two choices: you either talk or you don't talk about it, and that's kind of the 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 ones that I could come up with. I think everybody's thought process is going to be different as to how they would treat it, and I'm not, and I guess we could just leave it at that. I think it's really one of those tough things as to are you doing this at work? And if you are, then obviously it kind of goes back to the earlier ethical dilemma. Maybe it's being tracked by somebody, and maybe that's something that shouldn't be done. So I think there's a fine line and a balancing act as it relates to these type of various dilemmas. So on to the next one with that. Mike is a new employee in his accounts payable department in a small software sales company. He recently graduated from college, and this is his first professional job, so he's fresh right out of college. Brenda, a longtime experienced sales manager with the company, travels extensively. She approached Mike for help in submitting several expense reports for business-related travel, and Mike has assisted Brenda in the past to make travel arrangements for her, as well as complete her expense reports. As part of the completion of these expense reports, he notices that there are unauthorized items on these reports, such as massages at health clubs and manicures. When he approached Brenda about this, she angrily told him to just submit the report like you were told. Mike and his wife recently had a baby, and Mike is the sole source of income for his family. So what are the options that Mike has available to him as part of this, as part of his position? So one of the questions on here is, who is Mike's supervisor, right? Because does not appear to be that Brenda is his supervisor. So if Brenda is not his supervisor, he obviously has somebody that he can talk to. He can go to his supervisor and say, hey, these things don't look right. So that's one option. Option two is he can show Brenda the policy and say, hey, I'm trying to submit this like you told me, like I'm being told. But I'm just worried from your perspective, these things are going to get kicked back by somebody other than myself. Or thirdly, he can just do what he is told as she is indicated on here. So those are the kind of just a few options that he may have in handling this scenario. So what does the firm offer you as an employee? And one of the things that the firm actually does offer is they do have a reporting ethics hotline. And what I've done on this slide is kind of included the information as to how, if you come across an ethical dilemma or an issue, you can obviously talk to your supervisor and your supervisor's supervisor, but there is also a way to go about reporting any potential reporting issues that you may have, or unethical or illegal conduct that you see that makes you uncomfortable, that you feel you cannot talk to or want to try and stay anonymous. And there is a toll-free hotline, 877-472-2110, or email, or you can fax alternatives, and then also a website on this slide. So that the firm actually has invested in this and does provide this as a service to you as an employee. So it's going to take this moment just to do a kind of like a public service. I'm not sure if anybody was aware of this service that is being provided out here, but it is something that the firm does offer to everyone. There is additional information. I'll just pause momentarily on this hotline. If you go onto the ampersand, there's a whole written policy on it. If you type in the search section, if you just type in ethics, towards the bottom part of that search function will be a 2 or 3 page PDF document that outlines the various information in addition to just this. This is just the snippet for the reporting section, but also kind of goes through the overall purpose of it. Obviously, is because the firm does take these matters very seriously, but the purpose and also the various types of claims and that sort of thing that could be reported through this hotline. So here's some just simple, fun guidance and rules. Right is right and wrong is wrong. And a body ain't got no business doing wrong when he ain't ignorant and knows better. And so this is from Mark Twain in The Adventures of Huck Finn. And I think everybody can relate to this, that if you know it's right, you shouldn't have a problem doing it. But if you know something is wrong, and then generally you shouldn't do it because you just know it's wrong. So jumping into the AICPA Code of Conduct, I know we've touched on it throughout this presentation in a couple different spots. And I think one of the spots here that's interestingly to talk about is really about the acts discreditable to the profession. So within the Code of Professional Conduct in the AICPA Guide, it speaks to these acts that if you do them are really you're discrediting the overall profession. And there's a whole section on this of in ET 1.400. And just want to talk a little bit momentarily here of just some examples of various acts that would be deemed to be discreditable to the CPA profession as a whole. One of them would be discriminating and harassment of employment practices. And obviously we have discrimination and harassment policies and procedures as part of our normal HR manuals. The solicitation or disclosure of CPA examination questions and answers. So if we have questions and answers to the CPA exam, let's say before it's been administered, and we go ahead and try and advertise those to our own internal employees or sell them online or something for whatever, I don't know why we would ever do that, but that's actually deemed to be a discreditable act. If we fail to file a tax return or pay a tax liability, that is deemed to be a discreditable act. So if we do not personally, like let's say we just don't stop, we as an individual stop filing our tax return or we stop making payments for taxes because we don't want to pay any more than we already do, that's discreditable. If we're negligent in the preparation of financial statements, so we disregard that subsidiary that should be consolidated in, and we ignore that, as we looked at earlier in this presentation, we had an example like that, that would be deemed to be discreditable. Now, again, it's important to point out here that just because if we make a mistake or there's an error, that's not deemed to be, it may not be, depending on the facts and circumstances, might not automatically default to a discreditable act of profession. If there's a lapse in judgment or just based on the facts, we just made a wrong conclusion, that's not going to be the same as what's really being captured under this. Also, taking confidential information and sharing it with everyone in that's obviously an act that's not appropriate. So if we're taking confidential information, sharing it with the masses, that's not smart to do. If we make false or misleading, deceptive acts in promoting our services. So we are the best. This is the whole example. I know everybody that's on this ethics from 4 years ago, because this is the one that comes to mind for me. Best CPA firm, right? Unless your name's Best, you can't really use we are the best CPA firm. Use of CPA credentials. So if we have somebody that hasn't passed the exam and they put CPA on their license and they are not a CPA in the eyes of New York State from all the licensing requirements, but they hold themselves out as a CPA, that would not be appropriate. The couple other last items within 1400 that are specific to the firm really deal with a lot of records requests, which we spoke to earlier in the sharing of work papers and when we have to give those back, as well as the transfer of client records from sales or discontinuance of a practice, the removing of client files if somebody were to exit the firm, and then the use of client information from non-client sources. So if we obtain confidential information on an acquisition or something for a non-client, there's specific rules that still bind us as part of the profession to ensure that we maintain the confidentiality of that transaction, even though they may not be deemed to be a client at currently. ET Part 2 is on here is because you may not be aware of this, but as a board member, let's say that you serve on a board separate to your overall practice of accounting. So think of it almost as twofold. When you walk into your office, wherever that may be, across upstate and downstate, you are really following the AICPA Code of Conduct ET Part 1 because you're a member in public practice. So you're CPA in an accounting firm. That's where your rules will drive you for that day. And then let's say that night you drive down the highway and you go to your volunteer board. Well, there's actually a separate set of rules that now come into play and that now drive your actions as part of that volunteer position. And those are actually housed in ET Part 2, and that's called the members in business. And ultimately, that's going to say you cannot, there's a lot of the rules are very similar. So since this isn't really meant for members in business, I won't spend a lot of time on it, but do know that, let's say, not that this would ever come up, but let's say if you withhold information from from the CPA of that organization that's doing your review or your audit or what have you, that actually is also deemed to be an act that's discreditable and will be considered to be a violation of your potential license. And the reason why they put this into play a few years back, I think it was 2012 when this came into play, was really to say, hey, look, just because you were a CPA and now have put your license on hold and haven't been meeting the practice requirements, that doesn't mean that we're not still going to hold you to a high level of independence. That's not. You are still bound to maintain the specific ethical and integrity issues as it relates to independence. You may not be independent as it relates to an entity where you're a volunteer, but that doesn't mean that you're exempt from still having to hold yourself out as a person of integrity. There are a number of different sources that are available to you for various rules. And these rules are really broad from depending on where you're practicing and what you're practicing in. So for instance, this is Part 29 of the New York State Law, and we went through this earlier in this presentation. So this is kind of a good source if your Google machine's not working and you really want to read the New York State Law. Included in this presentation are the specific New York State Law HTML site. So you can just type this in and it will take you right to that Part 29 where all of the New York State laws are for CPAs. AICPA Professional Code of Conduct. This is what we were just talking about on this slide right here, this previous slide, the ET Part 1, ET Part 2. That is housed on the AICPA's website right there. If you have access to Checkpoint internally, this you will be able to locate on Checkpoint. If you go to AICPA, once you click on that, you will click on Professional Standards. And then under that, there down a little bit down in the middle of the page is a specific section called Code of Professional Conduct. And once you click on that, it will then drop down and give you ET Part 1, Members in Public Practice, ET Part 2, Members in Business, and then under that is a lot of the different rules specific to those sections of the law, and it goes of the code and goes further along the lines that you can gain additional insight surrounding all the various rules and regulations as a CPA. The New York State Society of CPAs Code of Professional Conduct, we'll get into that momentarily. That is where their professional code of conduct is maintained. That's located right here on this slide as well. They have one of the longer URLs, if you will. The PCAOB also has their own set of rules and regulations, as anybody that does a PCAOB engagement is well aware of. One of the main differences that I'll highlight between the PCAOB and the AICPA Code of Professional Conduct is under a PCAOB audit engagement, you are required to, on an annual basis and or prior to accepting an engagement, indicate to the client that you are independent of them, as well as all of their affiliates and of their sponsors. And not only are there PCAOB rules for independence and rules and ethics, but you will also be certifying as part of that letter to, it's a good segue, the SEC rules and regulations, and that you are independent as they relate to that. So, just touching briefly on the SEC rules, they are here. This is Regulation SX. Now, Regulation SX speaks to the independence as it relates to the auditor. So, Rule 2-01 under Regulation SX is what are the rules for being an independent auditor. There are also additional rules that are more granular in detail, which is Rule 33. For the SEC, if you do have to look at the SEC rules, go into Google and type in SEC independence rules, and then that will pop up all of the independence rules. But if you're looking for just the specific, I want to know what is the definition of an independent auditor under the SEC rules, that's where you're going to find them under Rule 2-01 of Reg SX, which is included here. One thing I do want to pause on and go back to that I just thought of for the AICPA rules, a lot of times the firm will do non-attest services for our clients, and the question always comes up is, how do I know if I am independent? What can I or can I not do? And those rules under the AICPA Code of Professional Conduct are actually housed at 1.295. And so as part of that 1.295, whatever .000, certain ones, so 010 for instance is bookkeeping, will lay out the procedures that you can and cannot do under a bookkeeping arrangement. So for instance, we know from booking arrangements that we can prepare bank reconciliations, let's say, as long as we're not booking them or making judgments on them. Those specific requirements that allow us to do that are included within the AICPA Code of Professional Conduct. Performing valuation services, what generally we cannot do those as part of an audit or review because we will be relying on that work, and that's also housed in that 1.295 section of the Code of Professional Conduct. So it's definitely something to keep in mind that Code of Professional Conduct has a lot of non-attest service guidance included right in it if you ever do need to look at that. The GAO Yellow Book has their own specific independence rules. Chapter 3 of the Yellow Book speaks extensively to what can and cannot be done. As everybody that plays in this space is familiar with, there is a lot of guidance and requirements as it relates to Yellow Book engagements and just a significant amount of documentation, probably a higher burden of documentation than what is in the AICPA world. So something to keep in mind there. Right now there is a lot of discussion in the Yellow Book world, as we are all aware of, that there's SKE documentation that needs to occur, that we need to document the skills, knowledge, and expertise as it relates to the individual. Well, I think what's happening, or you're seeing a small shift in the AICPA world, and they will clean this up, so we should not change anything that we're doing. Technically, right now, there is no specific requirement to document the SKE of a individual that oversees our in Yellow Book, or I'm sorry, pardon me, our non-attest services as it relates to a general AICPA engagement. We, as a firm policy, do require that the SKE be documented, so there should be, again, there's no change here, but just something interestingly to note, the AICPA will clean that up, and ultimately you will be required to document the SKE as it relates to your job, regardless if you're Yellow Book or not. But there is a subtle difference there. But don't change what you're doing, but just know that there is that little bit of a difference, but it will get cleaned up. More of an anecdotal thing more than anything else, just to provide a little insight into this. One other thing on the SEC rules, they have a number of FAQs out there for their independence items, and the AICPA does for that matter as well, and they speak to a lot of very narrow type items, so how to deal with when the SEC rules originally came out, there was some transition guidance that was provided in there. A lot of the 11K, so anybody that works on 11K engagements from an SEC independence perspective, those specific things are covered in the SEC FAQ rules. One thing is, if you do look at employee benefit plan engagements and you do a AICPA rule, it's not on this slide for whatever reason. There are DOL independence rules. So when you do a employee benefit plan, you're dealing with two sets of independence rules. You're dealing with an AICPA normal set of rules, and you're also dealing with a DOL set of rules. And if you do an 11K, you're dealing with the SEC rules as well. And really, what those rules indicate on all of them is that we have to be independent of the plan sponsor. So even if we don't audit that plan itself, like let's say company A is a manufacturer, they have an employee benefit plan. We audit the employee benefit plan, but not company A. We still are required to be independent of company A. So that's in the DOL rules, but not necessarily in the AICPA rules. Ultimately, we have to look to which rule is the most strict and follow that specific rule. So that's really what we have to be cognizant of there. The IRS has also issued a Circular 230, which speaks to some of the independence and ethics rules. And then obviously we'd be remiss if we did not include our International Federation of Accountants in here as well. They also have a specific ethics section for their individual members. One thing to note on the international section is generally they mirror the AICPA rules, so there's not generally a significant change between if you're dealing with like an AICPA or IFRS type engagement. Generally, the independence rules are the same for both of them. And with that, I'm going to give you another code. It's going to be code letter P as in Paul. Code letter P as in Paul. Many of you on this webinar are members of the New York State Society of Certified Public Accountants, and you probably are aware, and maybe you are, maybe you're not, that as part of that New York State Society of CPAs, if you will, you are bound to a code of conduct that they actually have published. So the New York State Society of CPAs has their own code of professional conduct. And what that code of professional conduct is, it will go in detail, is it lays out the way that they believe that their members should act, similar to the AICPA. Their AICPA code of professional conduct is how they believe that their members should act. So really no different as it relates to the expectations on any code of conduct. So with that in mind, we're just going to take a look at the various code of conducts for the New York State Society of CPAs. The New York State Society of CPAs is a voluntary association, so there is no requirement to be a member. That's interesting because if you think about it, we are all members from a professional standpoint, but it is just a voluntary organization. As part of being members, we are agreeing to follow the code of conduct. Some of the sections of the code of conduct are really dealing with laws and rules and regulations surrounding independence, due diligence, confidentiality, normal items that we've kind of gone through as part of the AICPA Code of Professional Conduct, rules and laws and regulations of New York state law. Ultimately, a lot of this is very similar to it. It's not like they went out and have created this whole new set of standards that we now need to be concerned with. Again, it's just another code of conduct that they have that really is similar to everything that we're seeing. Other sections of their code of conduct relate more to ethical concerns, and they try to address and make it more of a real-world situation item versus more of the AICPA. And the AICPA does that too, as you're aware, with surrounding a lot of the non-attest services sections that they have, and just working through difficult real-life situations so that you can look to it to kind of get a sense as to the various rules that are out there. As I've mentioned a couple times in my dialogue here, for the most part, the New York State Society of CPAs is in conformity with the AICPA. So again, if you've been following along with the AICPA code, it's not that different with the New York State code. So again, this is just more of a for informational purposes. And again, it's not going to be anything where now you're going to be like, I have to go change the way that I'm handling my clients. It's the same thing. So don't panic. I guess at the end of the day. The organization is very similar to what we saw with New York state law, right? There's a law, a regulation, and a rule, and this kind of follows along the same kind of mentality, but it does follow a slightly different fact pattern, in the sense of it says there's principles, which are general statements of the culture of the CPA profession. So, you need to be independent. There's rules associated with that principle, the application of the guidance, if you will. So you need to be independent, and here's how. And then there's interpretations, specific aspects of the rules, saying if you do X, here's how you would maintain your independence. So again, it's very similar to how the New York state law is set up, in the sense of there's a principle, a rule, and interpretation. Ultimately, it's following along New York state law, which makes it relatively straightforward. So in order to comply with the code of conduct, it really comes down to being able to, you have to understand and you have to agree to follow the underlying code of conduct, right? Because again, this is a voluntary organization. So you understand and you voluntarily agree to do it, and therefore there's no significant issues or anything along those lines. Secondarily, the code of conduct really has a reinforcement issue, as well as kind of a disciplinary proceeding type section tied to this. And the reinforcement is really done by peers through various articles. And additionally, from a public opinion perspective, a lot of it is covered as part of these trainings that were, so the ethics training is also the reinforcement of the code of professional conduct and how to appropriately conduct yourself as part of the overall business of being a CPA. There is ultimately a disciplinary proceeding sections. I know we haven't discussed those in great detail as part of this presentation, but there is a ethics committee at the AICPA level as well as at the state level that will discipline various CPAs when there's ethical issues that arise. A lot of times they relate to where the tax accountant is withholding the tax return from the client or does not file on time, and there's a lot of issues with that. So that's kind of that reinforcement, if you will, is disciplinary proceedings. Because if people don't follow the rules, they need to understand that there are consequences, and that's kind of the impetus of the New York State Society, as well as to say, hey, if you don't follow these various CPA rules, then there's going to be punishment. It may be in the source of fines, suspension, or additional work that needs to be done at the accounting firm level. One thing to note is, I know on this slide that there's an indication that there's criminal and civil litigation, and there's fines and jails. I've never heard of anybody violating the New York State Society Code of Professional Conduct and going to jail. So interestingly, it is on here, but I've yet to see that happen. So the principles, at a high level, the principles are here. There's the public interest, there's integrity, there's objectivity, there's due professional care, there's competency or confidentiality, competency, and independence as well. And over the next few minutes, we're going to go through these various topics and kind of discuss what each of them means, and kind of just give a high level overview surrounding the specific principles that are out there. And if you were to pull up the New York State Society of CPAs Code of Conduct, and that's actually presented as part of the link to it is included in the slide that was presented earlier. It's broken out into different articles. So Article 1, 2, 3, 4, 5, 6, 7, and 8, and they all correlate with the previous slide. And they kind of have the specific items included in here. And so what we've done, so for instance, this Article 1 relates to public interest. And really what that looks to is what is truly expected of the CPA and of the profession. And that's really that the profession is objective and acts with integrity. And with various different situations under the Code of Conduct, the act of acting with integrity and serving and being objective really goes to serve the public trust. And so it's public trust over your own interest. And ultimately, the individuals that are listed on this slide, or the groups on this slide, clients, financial institutions would be credit grantors, governments, employers, investors, etc. really look to the CPA to provide that level of trust and to really issue a report that is objective and fair and is independent, right? It says it right on our audit and review reports, independent accountants or independent auditors. So it's right there, and that's really what Article 1 goes to drive to, is to say, above all, you need to be objective and hold yourself out with a high level of integrity. Now, we'll get to the independence piece later on, but that's kind of the main part of Article 1. Article 2 looks to the integrity piece again, and it says the public trust is derived from integrity. And ultimately, as being integrity, it kind of outlines items that this is some examples of what integrity looks like, quote unquote, from a New York State Society Code of Conduct. It's being honest and candid with your client. It's telling them what they want to. It's not telling them what they want to hear. It's telling them what they should hear or what the right answer is. They might not like that answer, and I think that goes to bullet 4, that there's a service and public trust over personal gain. That if they don't like the fact that they have to file a specific tax return, we got to tell them they have to file that tax return, and it might not be what they want. But again, our responsibility is to the public trust and to the overall insurance of, as we noted earlier, the government in this tax return example. And a couple other items that it does note here is that, am I doing what a person of integrity would do? Am I being objective and independent? So as part of the application of Article 2, it does speak to the fact that you may lose the client, because if you're acting with the best interest of the public involved, that might not be in the best interest of what the client is, and you may end up losing that client because of various ethical integrity or integrity issues with management. And so what that's doing is it's kind of saying that you need to put you need to hold your integrity and the integrity of the profession over the wants or desires of the client. It may ultimately end up in you losing the client, but I think the bigger question on that situation would be is do we really want to be involved with a client that maybe is a little unethical or tries to blur the lines to a certain extent that's maybe not appropriate. Article 3 looks at objectivity, and it really says objectivity is a state of mind. And what that's really driving to is it really says you need to be objective and impartial and really apply and be free of conflicts, right? So you need to be objective when you perform services. So a lot of the services that it speaks to are test services, so preparing financial statements, or tax returns or management advisory, internal audits, education, forensic, really saying that we need to be objective when we're providing those services, regardless of if we perform a test on one day and tax on the other. It's really bringing that fresh look and that objectivity to each of the individual specific procedures that are performed. So the question would be is if we are just preparing financial statements or consulting services in a test function, are we really being objective? And the answer to that is obviously the independence will drive the facts and circumstances to that. But under the New York State Code of Conduct, the CPA Code of Conduct, it would say that for regardless of what level of service that you are performing, that you need to maintain an objectivity and in your mind and be objective to the state or to the service that's being performed. That's not to say that we are going to be independent for every service that we perform, right? I mean, if we do various work for them, we may impair our independence, but that doesn't mean that we aren't doing that service objectively and open and honestly. It just means that we're not independent based on various accounting rules. For Article 4, it's really looking at due professional care. And when you step back and you think, well, what is the essence of due professional care? And it's really this first bullet, right? It's the quest for excellence. You want to be the best that you can be, right? It's the old Army saying, be all that you can be, and really look to do your job the best possible way that you can. You obviously want to observe the standards from a technical and ethical perspective, and and do a good job and be timely and file that tax return on time. And all that goes down to being able to do your job, and that just goes, all of those things that you probably do on a daily basis is really just do professional care. So it's really taking what we do on a daily basis and saying, hey, how does that tie into the New York State Code of Conduct? We do all these things, so now how does that relate back to this Code of Conduct? And this is the piece of it where it's linked in. It's in Article 4. So competency. This is the quest for continuing lifelong learning. This is our CPE requirements. This is all covered within Article 5. The bullet here says you are here even by force. What does that mean? Every 3 years, you've got to have ethics training. Guess what? Here you are having your ethics training. So you're continually learning. You're continually looking to enhance your expertise and your knowledge base, if you will. You want to continue to be better, and that's really what is in the AICPA Code of Conduct, is to continually improve. One thing on here is, interestingly, is consultations and referrals are good. And what does that mean, or what is the point of that within the Code of Conduct? What that means is, when we don't know what the answer is, or maybe it's outside of our scope of expertise, if you will, that we're willing to reach out and willing to go down the hall and ask somebody, hey, I've got this client situation. I'm a tax partner, but I don't know what that issue is. Hey, audit manager, can you assist? Because this is probably more in line with what you do. It's having not the fear to ask the question, because they're all of our clients. It's not like they're certain people's clients, but where you may be in over your head, willing to step back and ask for help. Again, earlier in the presentation, I spoke to me never wanting to do tax returns or not doing a tax return. If I have somebody come to me and say, my neighbor comes to me and says, hey, I want you to do my tax return, I'm more than happy to talk to somebody in the tax department and refer them over, because I am not the right person to be doing that tax responsibility. So on a number of different levels, from a risk perspective, it makes sense. On a core competency level, it makes definite sense. And under the Code of Professional Conduct from a New York State society perspective, it also makes sense. So personally, for me, it's more of a safe face issue, because I would have no idea and would mess the whole thing up. But anyway, tying it back to this presentation, that's kind of the overall competency aspect of it. Article 6 speaks to confidentiality. A lot of this is generally basic stuff. We just keep and maintain our clients' information confidential. There's a couple things as part of that. There is an expectation on the part of management from us for them to share information with us. So if they're looking to do a significant transaction, that they're willing to share that information, because they know, it's an acquisition, they're going to go out and buy a company. They know that we're going to keep that information private. We're not going to go out and share it with other competitors or with other people outside of the firm, to where there would be a compromise of their individual information. It's kind of that trusted advisor role that we do serve, and part of that is keeping information confidential. The benefit of this from just a normal business practice is that it may lead to more fees, because our opinion is trusted. It also might provide additional work opportunities, because if they can trust us with very highly confidential information, then the expectation is they would be more willing to share information with us, which will then drive potential areas to where we would be able to add additional benefit for their specific situation. And it might not just be in the form of like acquisitions and due diligence, but it might also be for various consulting projects or anything along those lines. Independence. Obviously, independence is very important. And again, this goes back to the objective in decision-making process, and independence in fact and appearance. This is, if you probably have heard this thrown around in the past. Independence in fact and appearance basically means if a third party's knowing all the facts as you are, would they deem you to be independence in fact and appearance? And a lot of times we run into this on a lot of different scenarios when people sit on boards where we want to do work for those specific boards. It might be one of those things where we are independent in fact, but maybe not in appearance. And this is really a judgment call by all parties. It's not only appearance by us as a firm, at the engagement partner level, and also at the client level, because ultimately the client is the one that will have to make that determination in a lot of situations. Obviously, with our input, if something doesn't feel right or look right for us, we're not going to go ahead and do those procedures or the work. There's always the ability to step down or step away from that engagement and do that work from a consulting perspective. If we're doing a test work, there's always a business decision that goes into the independence, in fact, and appearance, as well as the normal rules. But sometimes there is, it might look, or the rules might say it's black and white, we can do this. But oftentimes, if you look at and you step back and you look at, well, but wait a second, we've got this, that, and the other thing going on, and from an overall outside party perspective, maybe it doesn't look good from a firm perspective, or also from the client's perspective, to where the client is going to indicate, wait, you're doing all of these additional services for me, but you're telling me that you're independent. I don't agree. Something doesn't look right. I can't get comfortable that you're truly going to be able to issue an independent either audit report or review report or even an AUP report. And that's really where the independence, in fact, and appearance comes in. Now, again, from a compilation side of the house, it gets a little bit different because we are not required to be independent as it relates to a compilation. We would be able to issue a compilation report where we just say we are not independent. But again, that's one specific item within the audit rule or the test rules, but not really in this. So that's kind of the independence, in fact, and appearance perspective. So for the rules, these are the New York State AICPA rules and framework. These mirror the old lineup of AICPA Code of Conduct. So back in 2012, the AICPA changed the referencing for the individual rules and went to that 1.000.000 numerical ordering system. However, previous to that, it was all Rule 101, Rule 102, 103, etc., etc. And when New York State went through and adopted their independence rules and their code, this is the specific format that they did it in, and it mirrors the AICPA's old rules. The form and content has not changed from the old rules. So generally, if you don't know, by following the AICPA Code of Conduct, you're in essence following the New York State Society of CPA's Code of Conduct. So again, as we talked about at the beginning of this section of the presentation, it's the same thing. It's just got it's got a different name. It's a level below the AICPA. The importance of this slide is the inclusion of code letter E. So this is the code for CPE, and it's going to be on this slide. It's going to be code E as an echo. Code E as an echo. So again, this is also going through various rules for determination of information, discreditable acts, etc., etc. That disclosure of information that we talked about earlier just happens to be old Rule 402. So that's included in the New York State Society, but again, mirrors the AICPA rules as well. So when the New York State Society, again, this is the cooperative, and at a high level, this is kind of what we had talked about. Section 101 is the integrity and complies with the laws, and Section 2 is the general standards. It's the proper registration. And again, the code was really meant to comply with the New York State law, and that's kind of why it was put in. So now we're going to spend some time looking at some ethical debriefs. And again, this is going to be kind of where we're going to probably take some time to think through some various items that might have come through here. And the founder, Machiavelli, who is the founder of modern day political science, so actually said politics have no relation to morals. So ultimately the answer to this question is, can ethics be legislated? Generally the answer is no. So that's just kind of an interesting quote and a picture of him here as well. So he kind of, back when he was first starting his founding of quote unquote modern day political science, he basically did not believe that politics had any sort of role from a morality perspective. So we've talked a lot today about what are ethics and various ethical dilemmas, and we got some more case studies coming up and various ethical issues, and we've talked a lot about it. But what we haven't really talked about is where do ethics come from, right? I mean, that's a weird question to ask, but I guess if you step back and think about it, it's like, yeah, where do ethics come from? So this slide kind of shows a couple spots where ethics generally are formed, or where we're getting them from. And a lot of it really is not from a textbook. It's not from anything that's read. It's really coming from your own personal experiences, your backgrounds, and what you believe in, and your true understanding of how society works. One thing to note that it is being sensitive to that various actions that may occur on decisions that are made, and making sure that you're aware that any decision that you do make will have an impact on someone, or it might be someone in the firm, or it might be a client. But any decision that you do make, it's an opposite and equal reaction. So that's just kind of just some high level guidance, and what we're going to talk about now is kind of really going through some various approaches for analyzing ethical issues, and some of the challenges that we face as CPAs from an ethical standpoint. So conflicting pressures. A lot of us have a lot of pressures. Obviously, we know what's expected of us from our client's perspective. And again, as we looked at earlier and alluded to within the code, there's also the public interest aspect that we also have to consider as part of completion of our responsibilities and performance of our services. And there is obviously always that number one professor that we have to act with integrity. And it's not really a conflicting pressure, right? I mean, that's what decisions have to be made might conflict with our integrity, and we might not like the overall conclusion or the path that has to be taken. But ultimately, we know that as CPAs, we have to act with integrity, and we have to be very cognizant of the fact that our actions will impact somebody. And so a lot of times, as part of that, the first step in making a lot of these decisions that we may the difficult decisions, if you will. Let's take a difficult decision, not a basic what do I want my coffee kind of decision. There's no real ethical impact on that. Generally, maybe there is. I'm not thinking it through, but anyway, you have to identify that specific ethical situation, and that's really the first step to understanding that you may have a problem. And it might be one of those issues where that's very black and white in the sense of, all right, there's an ethical dilemma because our independence may be impaired, and I want to keep this client for many years. I've had this client for many years, and I got to figure a way. I don't want to lose this client, and they're a good test client, and I might have impaired our independence. So now what do I do? And it really goes down to you kind of know from your own experiences and your own knowledge and expertise what that ethical issue is, and so really it's a matter of now how would you go about solving it? And I think a lot of it deals with here's some questions as to how to deal with it. Is you look at that ethical issue and you wonder to yourself, and you probably will seek other peers and their comments and their thoughts just to make sure that you're not missing any of the facts and conclusions. And you'll look at it and say, okay, well, who's going to be harmed by this, or who's going to be benefited? Is it right? What's wrong? Have I violated a law? Is there a potential for me to be sued? Right? I mean, that's all part of these ethical questions that may come up and that you may be dealing with. They're all questions to ask as part of the initial fact gathering. Because ultimately, these ethical questions and dilemmas, really where it comes down to is you've got to know and understand what all of the facts are. Because oftentimes, the facts will drive the overall conclusion and ultimately the right answer. So if you don't have all the facts, it's very difficult for you to make that decision, and it probably puts a burden to where you could potentially be making the wrong decision if you haven't been able to sort through all of the individual facts and appropriate criteria accordingly. So as part of looking, once you've gathered all of those facts, you start to think through what are the different scenarios and the different alternatives. And I'm not going to get into the example that I had used earlier in the sense of you impairing your independence. I'm going to talk very, very broad brush discussion here because I don't want to try and steer this in any one direction or anything like that. So as you start to look through various issues, and on this slide there's an instance of financial accounting alternatives, what that are available to be reported. There's also tax return implications on this as well. That if we file this tax return, it's going to trigger an audit. If we don't file this tax return, they're not in compliance with various or with specific laws. That is potentially an ethical dilemma. Do you follow the law and follow the guidance and the specific interpretations, or do you say we're not going to file this tax return because we want to take a certain position on this, and so it's kind of an ethical dilemma, right? You know what the rule says, but maybe you don't follow that rule to the letter of the law. Obviously, in the tax world, there is uncertain tax positions. That's not really what the point of this conversation is, but that's just something to think about. So you would have to also consider as part of that, is my client going to be harmed by doing that, right? I mean, is the public trust going to be hurt if I don't file the tax return? But it's really, is my client going to be harmed substantially through penalties and through fees and potential litigation, to where maybe the answer becomes a little more clear, right? Your client probably can deal and handle an income tax audit, but the significant amount of fees and the penalties and the fact that maybe you should have filed that tax return and you hadn't may drive that answer. So what are some of the challenges that we face as accountants? I know we just talked about one of them with the tax issue. Obviously, the fact that the client may be penalized significantly from that. Obviously, there's the challenges that do face CPAs are maximizing the bottom line. We obviously all face competition, and also the stressing of the short-term results versus the long-term gains. Now, these may be different from a CPA perspective, but also they're faced by our clients, right? Our clients all face the same challenges that we do. So when dealing with these ethical issues and when weighing the different options, as well as looking at the specific alternatives from a public interest perspective, as well as from our client's interest perspective, we have to weigh all of these specific items to make sure that the ethical question is appropriately addressed to do no harm, if you will. That old doctor's creed of do no harm as part of practicing medicine. It's kind of can be applied to certain ethical dilemmas and ethical issues as well. So some of the basic questions that you can ask is it right or wrong? I mean, it's the second question on the slide, but it's kind of the most important, right? I mean, is it the right thing to do or is it the wrong thing to do? You kind of know, that answer. You may not like that answer, but you know that answer, right? Should I turn the lights off when I leave a room? Yeah, I probably should if there's nobody going to be in it, right? It's the right thing to do. There's your ethical dilemma. Or do I leave it on or do I leave it off? Silly example, but it kind of makes sense here, right? I mean, is it the right thing or wrong thing to do? Also, you look at the best way of communicating financial information. Is it good or bad? It's not necessarily going to be a straight up gap answer. There may be different interpretations for this reporting the same information. And ultimately, you have to look at all of the stakeholders that are involved and coming to those various conclusions. Is a stakeholder going to be harmed if I present these financial statements on the tax basis? Or is this stakeholder going to be harmed if I exclude expenses on their tax return? All things to consider. And then what should I do in the circumstances? Again, that's a tough one because it's facts and circumstances driven. Now, that being said, there are some various items to consider as part of that. From a technical competence perspective, maybe you haven't encountered that, but maybe somebody else in the firm has experienced the same situation or has gone through it and can actually provide some additional insight into the various conclusions and ultimately the path that was taken. So you can obviously reach out to your colleagues and there will be some sort of additional help that will be provided really just kind of on an informal basis. Doing the right thing or making the right decision is not always easy, right? As we've seen on a lot of discussion that we've had, as well as on some future case examples that we're going to have, it's never a clear-cut rule. Ultimately, maybe it is an evident rule, but it might not always be the decision is an easy one to make. There may be pressures to bend the rules, or just go ahead and this is how everybody does it. Just ignore it. We went through those 10 steps earlier on why ethics lapses. We went through them earlier as to what they were. You know, everybody does it, so why can't I? It totally makes sense, right? I mean, this is the way that it's always been done, so I'm just going to keep doing it that way. Ignorance is bliss does not necessarily mean that it's the right answer. And again, the right answer will often depend on your social upbringing, your past experiences, etc., etc. Now, sometimes doing the good of the firm may be at odds with your moral compass. So we'll talk momentarily as to what potentially you can do. You can always say no and be able to walk out the door, because if you truly believe in an ethical decision, that is always your right. So that's obviously that's a very extreme, obviously, case. And there's, as we looked at the ethical hotline and obviously talking to your supervisors, there's a lot of different alternatives out there than saying, okay, I'm done, I'm walking out the door because I didn't agree with one decision. So there's still a lot of there. That dovetails nicely into this next slide, because there is a lot of personal risk associated with certain ethical dilemmas that may come up. Is it going to impact my job performance? Will my superiors be upset? Will my colleagues look unfavorably on me? Not just unhappy, but will they look at me as not being able to make either difficult decisions, not play the game, or really is my moral compass, quote unquote, different with theirs? There's obviously the risk of litigation in addition to all this personal risk, both at the individual level, if it's an egregious enough act, as well as at the firm level. That's also an underlying piece of this, of various ethical issues that may arise. There's other pressures in part of our normal job that may take different forms. So the ethical question might need to be decided right this second, and there might be, because there's a time pressure on it. There may be job pressures. This client is very demanding, and they always want this answer, and they're always right on the cusp of going concern, and so they want you to just overlook a lot of continued negative factors. That is a pressure that is specific to that job, but ultimately goes back to some of the code of conducts that we've looked at, that sometimes you've got to tell your client what they need to know, not what they want to hear. Making margin, cutting time, personal pressures, peer pressures, all of those pressures impact the various ethical questions or ethical dilemmas that may come up. So what does that mean, and what can we do? Obviously, as we talked about just momentarily ago, there's always the door. You have to be able to sleep at night. I think ultimately that's how I look at a lot of these decisions, is am I going to lose any sleep over this decision tonight? And there's been many a time when I've dealt with a lot of independence issues where I'll come back the next day and say, this doesn't look right. I want to just think about it a little bit more. Everybody has their own way of dealing with things. Sometimes I'll go for a run or a bike ride and think of things just as issues come up, and I'm working through them more in my mind and rolling around in your head and that sort of thing. So it all works differently for different people. You are a CPA, so obviously you're bound to a certain level of integrity and objectivity, as we've talked about. And then obviously seek the opinions of others. Obviously professional excellence division is there, but again, we have an open door policy throughout the firm that everybody, other partners in your office or managers or even seniors at the lower levels have probably all gone through and dealt with a lot of the situations that you may be encountering and experiences as well. The last two are really the hotline for ethics. Obviously, the firm has an ethics hotline as well. The last one, contact an attorney if there is a true ethical issue. From this one, this is obviously a canned presentation, but you would reach out to general counsel of the firm if it became a litigious affair. That would be something that you definitely would want to do. You would not want to hire it on your own. If obviously there's individual issues from it, you may need to hire an attorney in addition to general counsel of the firm. So Mark Twain, again, another quote from him, always do what is right. It will gratify half of mankind and astonish the other. So if you do the right thing, mankind is going to be, yep, that makes sense. And then the half that's maybe unethical is going to be blown away that you did that. So just another little interesting anecdote from him. So now we're going to go through some various questions and some various topics. I'm going to, similar to what I did in the past, I'm going to read through the specific question and then go silent for momentarily and then come back and then we can talk about that. But before I do that, I'm going to give you another code. It's going to be D as in Delta. It's going to be code letter D as in Delta on that. So let's go right to problem 1. Some of these questions are independence related questions, so they should be relatively quick and easy and make sense. So can an independent auditor firm provide various additional services, such as the evaluation of a program's performance without impairing the firm's independence? So I'm going to give you a second to think about that. So again, I'm going to give you about a minute to look at this and just think through what the right answer is in your mind, and we'll reconvene and talk about it. Okay, so the answer to this one is, can an independent audit firm provide various additional services such as evaluation of program performance without impairing the independence of the firm? Pardon me, can't speak. The answer is generally yes on this one, because ultimately by looking at the evaluation of the service, we're kind of doing that as part of the normal procedures under a gas audit. So as a result, by doing this under a normal gas audit work, it doesn't really impair the firm's independence. That being said, though, various independent principles will still need to be maintained just because we're doing a service that generally would be followed under a gas service. If we're not issuing a gas opinion, doesn't mean that we're definitely out of the scope. So if it's just a general, let's say, non-attest type activity, we still need to make sure that there's various safeguards in place to ensure that we still are staying independent if we were to ever be in a position to audit the individual plan in and of itself. So that being said, let's look at the second question. Should an independent audit firm be rotated every few years to ensure independence? So I'll give you a minute to think about that, and then we can talk about that one as well. Okay, so should an independent accounting firm be rotated every few years? So in other words, should a company go out to bid after having the same auditor for 3 years or 10 years or 20 years? And there is no federal or state requirement to rotate auditor firms. Independence needs to be reviewed on an annual basis by the independent auditor. It needs to be evaluated, not just on that, but if there is a change in the overall facts of the engagement, independence would be considered. And I know this, so some examples on that is, let's say we are the auditor for for a business for a number of years, and all of a sudden this special consulting project comes along, and we would make 3 times the audit fee in 1 year than we would on an audit than doing the audit for that period of time. We may make the determination that it's worth walking away from the audit to have that initial bump. Again, it's all facts and circumstances driven, and it really truly does come down to an overall business decision as it relates to some of these situations. But at the end of the day, there is no requirement to go out to bid, if you will. We do see it in the municipalities and the school districts, and we'll generally go out to bid every few years, just as kind of like a best practice, and plus the state does require it. But there is nothing, again, that requires it. Another interesting point to speaks to auditor tenure is around PCAOB engagements. For PCAOB engagements in the audit report, you're actually required now to indicate the number of years or the initial year that you had served as the individual auditor on that engagement. So that's something new that that just came out in the last year or two. So if you do pull up any SEC filings, you will see on their individual audit report the specific number of years to how long that auditor has been. If that's more transparent, I don't know, but that was a PCAOB requirement, and now it's being done. Currently, I don't know if there is any plans from a AICPA perspective to require that going forward on any AICPA engagements. Not right now, there's not. So would independence be impaired if financial statements require a large number of correcting audit adjustments? So we may see this. It might be an interesting one for a lot of people on this webinar, because I think this is probably something that we do see within our overall practice, probably to a large extent. So just take a moment, maybe it'll take 30 seconds or so just to think about, is this something that would impair our independence? So on this one, for instance, the answer is it depends, and it has depends on the degree of input on the auditor and the client, the determination, the approval process, and judgment. So we obviously have certain clients that do rely on us to do a certain level of bookkeeping, and ultimately some of this bookkeeping may turn into where we do have a number of audit adjustments. And so how do we maintain our independence is often a question that may arise, and there's a number of different ways that's done, and one of the most common ways is just applying various safeguards. Maybe an EQCR review, there's board involvement, so there's definitely ways to be able to maintain our independence, and the key on this is making sure that we document the overall approach as to why even though there might be a number of entries, why we believe that we're still able to maintain our independence. And I think another thing that might get lost on this is not just the number of journal entries that get booked, but also perhaps the potential material weaknesses that may exist within our clients and their overall financial statement internal control environment. And I think we will obviously take a case-by-case look at that as a firm, and may reach different conclusions under different scenarios, really because it is all judgment, and the main thing that we need to be concerned about here is ensuring that we don't take on a management responsibility role, and that there truly is a divide between what we do as well as what management's doing. So with that, let's go to the next problem, if you will. Can an independent audit firm provide internal audit services to a school district or municipality and remain independent? So this question is really specific to our GCL friends. As part of their main audits, are they able to perform both the internal audit function and the overall the audit itself? So I'll give you maybe 15 seconds on this one, since it's really mainly driven to our GCL friends. So the answer on this is a straight up for municipalities and school districts is the answer is no, and that's prohibited by state law. Now, for attest clients, there is a little bit of for normal, let's say other non-attest clients. Generally, it's very difficult for us to perform an internal audit function, if you will, just because the independence rules are written in such a way that we really can't be part of management's overall control environment. And so as a result of being internal audit, the expectation is that we're going to be in there being management's control environment and being their function of ensuring that controls are in place and are operating effectively. So if we're asked to perform any sort of internal audit assistance, generally we can't really do it. Now, that being said, we can do consulting work surrounding the internal audit environment, or internal control environment. We can also do evaluations over the effectiveness, potentially. Not really, I'm sorry, I take that back from an evaluation of effectiveness. Really more so around we can look and see what kind of controls they have and maybe identify potential controls that they may want to consider. But we can't really go in there and express an opinion or provide any sort of assurance that the work that's being done is appropriate from an internal controls perspective. The rationale and the reasoning behind that is as auditors, it puts us in a position of auditing our own work, and as a result, we can't do it because we can't really be part of management, can't be a part of that overall internal control environment or anything along those lines. And we see this with a lot of non-attest services, not just from an internal audit perspective, but also from valuation services. So ValueQuest, we can't do a lot of the valuation work for our attest clients where that work, let's say for their pension plan, because it would put us in a position to audit our own work. There is obviously some valuation services that can be performed if they're related really specifically to tax and gifting, but they're very specific and very called out within the codification. So if you are looking to use a ValueQuest or an internal audit services, we definitely have to be very careful as to what we can and can't do, and probably will need to ensure that we're monitoring that so that we do not impair our independence in those situations. So on to question number 5. Question number 5 is, can an independent auditor help in the hiring process for key financial management positions? And now just to make sure that we're all clear, these are for a test client. These are where we are the independent auditor, reviewer, anything where we're issuing a independent compilation type engagement or any sort of a test service. So if we are only providing tax work to these individual companies, the rules generally are not as stringent because we are not required to be independent per se as it relates to those clients. And I'm being quiet just to give you a couple minutes to think about this question as to the appropriate way to how you would handle this. So in this one, providing an opinion on the qualifications would be acceptable. So you can assist in the sense of looking for and offering advice on if somebody seems qualified for a position that is at your attest clients. What we can't do is we cannot offer a salary information or take on a management role from a binding of a contract or making the decision to hire an individual for a specific position. So for HR type non-attest services, the main crux of this is, are we acting as management when it comes to the hiring process? And again, just answering basic questions on, does this make sense from a qualified person is different than, okay, I would offer the CFO $150,000 for this position. You should hire this guy. You can't do that, but you can definitely speak to, yes, this individual has the appropriate level of qualifications, at least based on their resume or based on known information that we may have. It's just we cannot bind our clients or enter into like a contract with that CFO to perform those services. Okay, on to question number 6. Carol sends an email to Ed stating she disagrees with the actions Ed took on the project. Ed shares the email with Frank. Frank prints the email and gives it to the department head, who reprimands Carol for sending it. Was this ethical? So this question more is outside of the scope of independence and independent questions, and really is geared more towards an ethical situation that may be encountered as part of your overall role. So it's really more of an ethical question than anything else. And in the interest of time, because our time is running short here, which I'm sure everybody is upset about, I'm going to go ahead and give you kind of just some high-level thoughts on this specific issue. Again, there's not really any right or wrong ways to answer at least this specific question, because it is more of an ethical question than any of that. And do keep in mind, as we have discussed in the past, that ethics is really kind of your own internal upbringings and internal items that you've dealt with over your life versus kind of like a set of rules. Independence rules, those are different. Those are truly driven off of specific issues and items that have been encountered. But as it relates to these ethical dilemmas, they're really specific to you on a case-by-case basis and really your own core set of beliefs. That being said, emails should be considered public information, so before you type something, you should expect that email to be read by somebody outside of the organization. If there's any subpoenas or anything like that, they may subpoena this email, so you should be very careful as to what you say or indicate in an email, because it could become potentially damning to you as a person. If you want to disagree on this instance, why through email? Why not pick up the phone and call that person, or just have a meeting with them versus just putting it in an email. The question really comes down to in this is who did what and why, and really just it's really meant to just get you thinking about, should I be putting stuff in email, and should I be really just leaving it out there for the whole world to see to some extent. So it's just a normal cautionary tale on this, and stuff really more from an audit perspective is when we do have emails that we may send back and forth, just to be very careful as to how we put that wording in an email, because it may become a public record at some point. And we definitely don't want anything in there that would look negatively on anybody. So just a couple final things in closing. Ethical dilemmas. Dilemmas actually come from the Latin of die meaning two, and then lemmas, which means assumptions or courses of action. So with that, I'm just going to kind of breeze through these next two examples. An individual has two candidates that are looking for a position. One individual is offered the job. They don't get it. They decline it after a period of time. So then they offer it to another person, and that person asks, well, was the job offered to the first candidate, and how would you respond? And I think it's ultimately a matter of, again, personal preference and that sort of thing. I guess the times that I've taught this course live, and the question's always been, well, what's it matter? Do you want the job or not, right? I mean, that's kind of that's really, truly the easiest way to put it, is if you want this position, then what's it matter? You should be happy that the person didn't take it versus that they would have taken it and that you weren't even considered anymore. So that's just kind of a one dilemma as to how to respond. Another one deals with a firm that went for an audit that went out to bid, and then ultimately another firm was selected, and they run across each other in a public setting, and the question was, well, why wasn't my firm selected for the auditing services? And it's really because of fees. And I think generally this is a very, it's really based on the relationship that you may or may not have with the individual, I think, is how it comes down to in my mind. It's always been, if you feel comfortable asking those questions and with that client, because you never know, in a couple of years you might be in a reverse position where it's you have to deal with this person again, and you don't want to leave a sour taste in their mouth. So just some things to think about. So in summary, I guess you cannot rely on your ethics rules and laws and to provide an answer for every circumstances. There is no appropriate right way or wrong way of doing things. Again, there's no written rule from an ethics perspective. So it's really just based on your underlying assumptions and kind of your beliefs and your social upbringing more than anything else. So we've been through a lot of the New York State requirements and rules and regulations and things like that. And a lot of this is all directed and dictated that we have to have and have to discuss the specifics of the laws and the regulations for the state of New York. So unfortunately, we don't have a lot of practical items that may pertain specific to the firm. That being said, the good news is now for this portion of the presentation, we're going to focus a little bit more on items that are relevant to the firm and not just to the overall general state of the practice and state of the state of New York telling us what to do. And so on this slide, you'll see the first thing, which is it just takes a moment to just kind of reiterate this, because it's definitely something that we believe we've done a good job of communicating as PED, but also want to make sure that everybody's still aware of that. It is a requirement of the firm to ensure that there is an engagement letter for all services performed. And that's regardless of if it's a test service, be it an audit, review, or compilation, or an AUP or an examination, but also really where these become very, very important. Also on the tax side as well, but also on the consulting side. So if we're doing just regular consulting work, be it for internal controls or just normal, we're going to come in and consult on business acquisitions, it's definitely important to get an engagement letter. And there's a couple of reasons why, and I'll just touch on them briefly. Obviously, from a risk management perspective, it's very important to have all of those procedures laid out so that if there's no misunderstanding between our clients and us. It also will lay out the specific deliverables that are going to be provided if we're going to issue a report, or if it's just going to be something verbal. That's all going to be included in an engagement letter. Now, I know there's a lot of discussion and a lot of questions over certain smaller projects that might be like one-off type things, and do I need to get a 6-page engagement letter? It ultimately comes down to facts and circumstances, and depending on the significance of the service that's being performed, you may be able to do it in an email. It really depends on the services, but the main concern is really just making sure that there's a clear understanding as to what we're doing, who we're doing the work for, and just making sure that there's no misunderstanding at all. Also, from a collectability standpoint, it helps us to ensure that we're going to get paid for the work that we're doing. The attorneys that we use for our collection attorneys will not even take a claim unless there is a valid and signed engagement letter. So that's important to note, because if we don't have an engagement letter, it's very difficult for us to be able to go back to our clients and collect if there is an issue with payment. So just keep that in the back of your mind as well. So there's just a friendly reminder on the engagement letters. So another thing that we see oftentimes are these third-party verification letters. And these are where you get a call from your clients, and they may be a tax client, it may be an audit client, and they want you to confirm their wages, confirm their amount on a line of credit, if they're going to be profitable, or if they're going to continue to be in business, if it's for a business or a company itself. And generally, we're very limited as to what we can and cannot provide on these third-party verification letters. And a lot of the ones that we've seen recently that have come through have really been around the lines of the company's going to be profitable, or the company is still in business, is going to be in business in a year. And those, there's really no way for us to issue any sort of letter that speaks to that. We can't really even, there's no way, we can't see the future. If we did, we probably would have all played the lottery and wouldn't be here listening to this webinar. So we can't really do those type of letters. Now, what we can do is we can say, hey, based on this individual's tax return, the person had X amount of money. Also made X amount of money from last year on their W-2. Also we can also say from a financial statement perspective, we issued US GAAP financial statements and total assets were X or total liabilities were Y. So we can do certain things like that. We can also issue a specific letter from debt covenants if they are in compliance with their debt covenants. There's a separate arrangement or agreement in the attestation standards that will allow us to provide a report on compliance with debt covenants. So there are certain things we can do, but for the majority of these we can't. One thing to note when you do get these letters is you can always entertain them, and we can try and come up with something that the client may be acceptable to the client and to probably the financial institution that's looking for them. However, if not, a lot of times these letters will be signed by attorneys or will be signed by like a registered broker, or broker dealers will sign these letters more freely than we will as a CPA profession. And that really goes, and so you might wonder, well, why can attorneys and broker dealers assign it? And really not the rationale, but the reasoning for why we can't is because our standards really prohibit us from doing a lot of these specific type of letters. But again, there's always something that we can do. It's not that we immediately can't, but we just have to be very cognizant as to what those are going to look like. There are some relevant guidance on this. A lot of this stuff there's a PED memo on this. There's the IRS code that speaks to if we are going to provide information to our clients that we have to get their permission to provide a lot of that. It speaks, in the AICPA Code of Professional Conduct, it speaks to these type of letters. There's position papers on this, FAQs on this, as well as response matrix grid from the AICPA that they've put out. Within our PED memo, it's important to note that we do have checklists as well as a sample language as to what that would look like generally from a tax perspective, because we normally see these on the individual client basis more so than on a company or entity type level. It's really mainly surrounding individual tax returns and individuals needing some kind of letter that says they're going to make X in the next year. Board involvement policy. There is a internal vetting process that must be done to make sure that if you're going to go sit on a board, that we're not far along in a target perspective of them becoming a client. This procedure normally does not take very long. Once you send in that email, generally it gets turned around pretty quickly. What we do at the PED level is we will look and review STAR. We will reach out to the team leaders in the specific market where this client is, and then ultimately, based on any internal review that we find, if there is no conflicts, we'll generally check with the management committee, who will then have ultimate approval as to the board involvement. And then once that board involvement's approved, we'll go ahead and send you a note letting you know that it's been approved, or if there's other additional questions or concerns that we may have, that we'll go through and talk through that as well. And then we'll also go ahead and update your independence form internally, so that next year when you complete your independence form, you'll see it already on there and it's been added, so that you can just continue to roll forward with that. But it is something important, because what we don't want to get into a situation is where we have been working a relationship and are very close to obtaining the audit, review, or comp or other attest work, and then have you go and sit on a board, and then ultimately we cannot do any attest work if it impairs our independence from a board perspective, and then ultimately we would lose the client. So this is there's a policy located here at PED, independence, board involvement on the ampersand, but also feel free to reach out and send inquiries to the DL team PED email database, and we'll go ahead and get that set up and everything like that moved along for you and approved. For our SEC engagements, this is a new policy for any new engagements. So existing SEC Ks and Qs, there's nothing we need to do, but for anything new, we are starting to run background checks on management and board of governance individuals. And so the policies and procedures are outlined in the SEC client acceptance policy. And generally, we have an in-house individual that will look to do a background check on the specific management and board of governance individuals. And then we would go ahead and document all that on this specific PCAOB form that's listed on the slide. This is, again, for any future engagements that we pick up, and will be applicable to 11K engagements as well as any 10K engagements that we pick up. If, for instance, it's a client that we've had for a number of years and they go public, there would not be the expectation to run the management and board of governance background checks on them. It's generally just on any new clients that have been or are currently registered. It would then be a subsequent a step that we would do. So that's kind of the SEC policy change. I know we did talk about this briefly at the ANA update in the past, so it's just another item to note as well, just kind of a reminder along those lines. The one new piece of ethics and rules that has come out that's impacted the practice is now effective for all attest engagements on September 1st of this year, and that's really the hosting services arrangement. And what this arrangement is really doing is it's really just saying we as an accounting firm cannot house and store and be the main back office service or computer service for our clients. So that we can't be management and control the overall and safeguard their general ledger or their security and backups and maintain their books and records, right? As we talked about earlier today, we looked at what we can and can't do from a work paper retention perspective, and what is their client's data and their client's records, and we went through a definition of that. And really that's applicable here as well, because this is really saying we cannot act as their main sole host and cannot be their operating system. If it is a non-attest client, we can do it and we don't have to worry about any of these rules. But if it is for any attest client where we do an audit or a review, it's something that we have to be cognizant of and be aware of that is out there. So the questions that we must ask ourselves is, are we accepting responsibility for the custody of the financial information? And if the answer is yes, then our independence is impaired under the new rules. So if we are, and we'll look at a couple case examples momentarily, if we sign an engagement letter that says we will maintain your books and records, we will ensure that you don't have to worry about any sort of disaster recovery, back office work, we will maintain your license for QuickBooks or anything along those lines, that's going to impair independence. The way that it is right now for the majority of these is if there's a third party involved, then there wouldn't be any sort of independence issues because we are not responsible for the custody and control of that information. It's another party. But if we have it housed on our servers and we have the backup and everything like that, it could potentially run afoul of our independence rules. So the new requirement is relatively simple, because I think this is the one case that we see generally in our practice, right? We have the software to run the client's depreciation schedule and calculate it. And they'll provide us with a listing of new assets in the current year, and we'll go ahead and say, all right, no problem. We'll plug it into our system and we'll send you in an item, and away you go. Here you go. Here it is. Here's the number. Book the entry. Well, the main thing that we now need to do as part of that is to send an email or letter or something and maintain evidence of that in our work papers. That evidence is that we've provided our client with that depreciation schedule, possibly in addition to the adjusting journal entry. And the rationale on that is when we produce that schedule, it's a bookkeeping service, yes, but ultimately we're creating their underlying books and records by creating that depreciation schedule. And so by providing that to them, we are ultimately returning to them their initial books and records and not maintaining custody of it. And so again, the whole point and whole purpose of this new service is to make sure that we are not in their individual chain of command, if you will. So here are some examples that will impair the firm's independence as they're under this new standard. We're responsible for their website on their server. housing the client's website on a server, so our server. So let's say our client has a website and it's self-explanatory. I don't need to go into it, right? I mean, everybody understands this. If we're maintaining their website, then that's a problem. The outsourcing of this to the CPA firm, the storage, which are maintained on the CPA firm's servers. So let's say they have QuickBooks, and it's not. And I'm just go with me on this one because this might not. This isn't probably how QuickBooks works. But we install that on our servers, and the client will access our servers and our computer system, and we'll do their bookkeeping in general and subsidiary ledger, any sort of schedules, legal documents, leases, anything like that is all housed on our firm's servers. That will impair our independence as it relates to the client. If we may agree to maintain all of their hard copies, so they do everything, let's say, on the old ledger paper. Therefore, they send us all the ledger paper and say, hey, hold on to this. We have a storage issue. Can you act as a quote-unquote Iron Mountain? No, we can't do that. That would impair our independence. They need to maintain it. If they send an engagement letter where we're going to show up with a Bonadeo van and be their disaster recovery if the buildings collapse to keep them up and running, and in the back of that van is all of their servers and everything like that, then ultimately that would impair our independence. We cannot be a disaster recovery service either for our individual clients. And when I say we, I mean Bonadeo, the firm. We cannot be named as their disaster recovery service, maintain any documents or anything along those lines. So here are some examples that do not impair our independence. So we obtain all of their payroll records, and we go through and prepare the tax return and do all of that information and create all the payroll records and everything like that. Ultimately, when we're done with that service, we go ahead and return all of that to them. So if that's the case and we return all that documentation to them, our independence is not deemed to be impaired, because ultimately, even though we're using that to prepare the tax return and to go through and provide the service, the fact really comes down to we're not part of their maintenance of their documents. We're returning all of that information back to them. So that's really the key point of this whole standard to a certain extent, is also that we're returning a lot of the documentation and evidencing that the fact that we have returned everything to them, so that if it ever did come up as part of an independence issue or inquiry, then we have evidence to support the reason and in fact that we have complied with the professional standards. Another example here is where we're doing write-up services where we have access to their QuickBooks account. Now, in this example, we have a license and so does our client. So there's two separate licenses on two separate servers. So our client said, hey, I know you provide us with bookkeeping. Can we just give you access to our data, and therefore you can just run us our financial statements? It'll make, you can book journal entries that we approve. We just want you, for an ease of doing business, to be able to access our information. And generally, does not impair our independence, as long as there's an individual at management that's taking responsibility for the overall financial statements, taking responsibility for approving those financial statements. And at the end of the day, the only thing that we're really retaining is our specific work product and any information that supports that work product. So again, it's really having that management role and somebody at management doing what they say that they're going to do and taking care of everything from an overall management responsibility issue on this one. So another example is where we are using, let's say, our normal My Portal type site. So as part of the audit or review or comp or any engagement, we may set up a share file site. And over time, we're sharing information on that site and turning on, sending documents up there, they're sending up documents, downloading, etc., etc. pardon me, what we have to be careful of is to ensure that we are shutting off that portal on a timely basis once we are completed with that engagement. So we've finished our engagement, we've issued our audit report. In order to make sure that there is no hosting services or even the appearance of a hosting arrangement, right? Because there might be leasing agreements or any debt agreements that have been traded back and forth. We need to shut that access off. And what the shutting off that access is going to do is it's basically going to say, look, we're not a hosting arrangement. We're just using this to share and make the audit more efficient along those lines. So just as a good reminder, a good best practice is to make sure that we are shutting off those My Portal data documents once we have completed the overall audit. Again, this is the depreciation schedule one that we looked at earlier. Just make sure that after we've completed the overall audit and also the overall depreciation item or the service, and after we've run the schedule, that we go ahead and provide that to our clients, and I won't belabor that anymore than I already have. So a couple new independence checklists that you probably are aware of that are out there. From a documentation perspective, there's an example CX 1.2, which is really for audits that are just normal audits, not yellow books. That's CX 1.3 is the yellow book template. I will note for CX 1.2, you might say, well, I have a review. Appendix 2.0 is the one that you will use for the review. That is pretty much the same thing as 1.2, and that would be for compilations as well. So if you follow CX 1.2 and you're doing a review and a comp, generally there's not going to be any, it's going to mirror the same thing. So it's, even though there's not a template for Appendix 2.0, CX 1.2, if you follow that, it's going to be the exact same. It's verbatim, word for word, because the standards are the same from a documentation of audit, from an independence, from an audit, a review, and a comp. It's just when the yellow book, as we come down to the next part of this slide, is really where it gets a little bit different and where there's more additional safeguards over independence documentation. And the hardline stand that's being taken on the yellow book engagements is if you do not document those safeguards, which would be part 3 of the checklist, then you have a non-conforming audit in accordance with the AICPA. Now, anecdotally, there's a lot of discussion that the AICPA is going to change the independence standards as it relates to these safeguards in the future to mirror the independence standards with the yellow book. And so there's a couple different schools of thought. One is they're going to mirror the yellow book, so there'll be additional safeguards. So part 3 may need to be completed. It may need to be completed on if you do CX 1.2 right now, but it might become mandatory going forward. And there's also the potential that they would go to the SEC independence rules and SEC side of the house to where we would not be able to prepare financial statements. So stay tuned on that one. There's nothing right now in the pipeline, but there's definitely a lot of discussion relating to this becoming the norm, to where we would not be able to prepare financial statements. So some documentation issues that we have seen from a QC perspective. Non-attest services are documented on the form that do not match the non-attest services in the engagement letter. So we may have some consulting arrangements that we're doing, or tax services that aren't covered in the engagement letter, that we just need to make sure that they will mirror up. On question 2 of part 1 on those forms, it asks if we considered all of the non-attest services, and if we're performing more than one non-attest service. So if we're doing, let's say, bookkeeping and tax services, then that answer should be yes. If we are providing one non-attest service, this answer must be NA. So that's just some things to think about on that. Okay, and with that, we are done with our 4-hour ethics presentation. So this is going to conclude our overall, one more thing. Here's the last code that you do need in order to obtain your CPE. So the last code is exclamation point. So it's just an exclamation point. That is it. So, and with that, thank you. That is all I have left. If you have any additional questions, definitely feel free to reach out to me and be more than happy to talk to you about ethics or any other questions or concerns that you may have. Thank you very much. Take care.